Have you ever looked in the financial papers and noticed that in 2024, Standard Bank's assets dropped by 2.47% while return on capital was up 22.78%? Is that good? Quickly glancing at other big banks in South Africa, their asset size also moved into negative territory, while Capitec, a much smaller bank, had its assets increase during the same period. So, what's it all mean? Are these numbers good, or are they bad? How do you know what story the numbers are telling us? Over the course of 4 Tuesday afternoons, we will dive into the world of financial acumen and how it can help align the performance of Standard Bank to achieve its e-commerce goals and digitization objectives. First, let's define what financial acumen really means. Simply put, it's the ability to understand the bank's performance metrics and make sound financial decisions. But it's more than just crunching numbers. It involves analyzing financial statements, understanding market trends, and making strategic decisions that drive profitability. So, why is this important for you? In the fast-paced world of banking, financial acumen sets you apart. It allows you to better serve your clients, identify profitable opportunities, and mitigate risks. Plus, it's a critical skill for those aiming for executive leadership roles. Now let's talk about how you can enhance your financial acumen. To start, we are going to immerse ourselves in financial data. Get comfortable with balance sheets, income statements, and cash flow statements. Practice analyzing them and drawing insights. The more you engage with financial data, the sharper your acumen becomes. In our breakout groups, we will discuss ideas and share experiences so we can gain new perspectives and enhance our understanding. Let's get up to speed. A bank's balance sheet, income statement, and cash flow statements tell a distinct story of how a bank is performing as an entity. Taking the same numbers and comparing them with other banks in a specific region tell us a different story. Contrasting the same numbers against banks of the same size in different geographies tell yet another story. So what is the story? Today, managers at all levels of a financial institution should have a level of financial acumen that enables them to see the numbers, understand them as a component of their local economy, place them in the context of their strategy for e-commerce, and perhaps most importantly, be able to tell their subordinates, customers, and other stakeholders what the numbers mean in the story of Standard Bank's future aspirations and ability to achieve specific goals. Financial numbers are financial numbers. They all mean the same thing, not necessarily. A bank's balance sheet is structured differently than other commercial ventures. To most companies, a loan is a debt to be repaid and is treated as a liability. But to a bank extending the loan to a customer, it is an IOU where they are owed money. Hence, the loan is an asset. There are other idiosyncrasies to how a bank is structured, fundamentally different from other commercial companies. The next 4 sessions are designed to sharpen your understanding of a bank's balance sheet and income statement. We will be discussing and developing a familiarity with key financial concepts unique to banking. Here are the fundamental things we think you should know. Let's start with the bank balance sheet. Assets, which are what the bank owns. Loans and advances are the bank's primary earning assets, including mortgages, personal loans, and business loans. Investments and securities include treasury bonds, municipal bonds, and other financial instruments. Cash and reserves include cash on hand and deposits held at the central bank. Other assets consist of fixed assets such as buildings and ATMs, derivatives, and goodwill. Liabilities, which are what the bank owes. Customer deposits include savings accounts, checking accounts, and term deposits. Borrowings refer to loans taken from other banks, central banks, or through bond issuances. Other liabilities include derivatives, repurchase agreements, often referred to as repos, and accrued expenses. Now moving on to shareholders' equity, also known as net worth. This includes common stock and retained earnings, which represent the capital invested by shareholders and the accumulated profits over time. Regulatory capital is crucial for ensuring the bank's stability. It is mandated by Basel regulations to make sure that banks can absorb a reasonable amount of loss and comply with statutory capital requirements. Let's talk about the bank income statement. This statement shows the bank's profitability over a specific period and consists of several key components. Revenue is often referred to as the top line. It's the total income generated by a bank from its various activities before any expenses are deducted. Net interest income, or NII, is a critical component of a bank's revenue. It comprises two main parts: interest income and interest expense. Interest income is the revenue earned from loans and securities. On the other hand, interest expense is the cost incurred from paying interest on deposits and borrowings. The net interest margin, or NIM, is calculated by taking the difference between interest income and interest expense, and then dividing it by the bank's earning assets. Non-interest income is another vital source of revenue for banks. This includes fees from transactions, asset management, investment banking services, and trading gains. These sources help diversify a bank's income stream beyond traditional interest-based earnings. Expenses include a few key components: provision for loan losses, or PLL, which are funds set aside for potential loan defaults. Then we have operating expenses, which cover salaries, rent, IT costs, and regulatory compliance. Other costs include depreciation and amortization. Moving on to profitability metrics, we have net income, which is calculated as revenue minus expenses and taxes. Return on assets, or ROA, is net income divided by total assets. And finally, return on equity, or ROE, which is net income divided by shareholders' equity. The efficiency ratio is calculated as operating expenses divided by the sum of net interest income and non-interest income. Generally, a lower efficiency ratio is considered better. Key ratios and metrics for analysis include the capital adequacy ratio, which measures financial stability, and the loan-to-deposit ratio, indicating liquidity management. The non-performing loan ratio assesses credit risk, while the cost-to-income ratio serves as an efficiency indicator. Unique aspects of bank accounting involve regulatory influence, as banks must meet capital requirements such as those outlined in Basel III. Credit risk management is crucial, with reserves for loan losses impacting profitability. Additionally, interest rate sensitivity affects the net interest margin and earnings. Liquidity, solvency, and profitability are three crucial elements in analyzing a bank's financial health, each focusing on different aspects of the bank's balance sheet and performance. Liquidity refers to a bank's ability to meet its short-term obligations and fund withdrawals. For banks, this concept is unique due to the nature of their business, focuses on current assets and liabilities, measured by ratios like the current ratio and quick ratio, reflects the bank's ability to convert assets into cash quickly, important for meeting immediate customer withdrawal demands. Solvency relates to a bank's long-term financial stability, and its ability to meet total financial obligations, concerns the bank's overall debt levels and ability to continue operations, measured by ratios such as debt to equity and debt to assets, reflects the bank's capital adequacy and credit quality, regulated by specific solvency ratios set by financial authorities. Profitability measures a bank's ability to generate income from its resources and operations, focuses on the bank's income statement and return on assets, equity, measured by ratios like net interest margin and return on equity, reflects the bank's efficiency in using its assets to generate profits, directly related to the risk-return trade-off in banking. 1. Time horizon. Liquidity deals with short-term obligations, solvency with long-term stability, and profitability with ongoing performance. 2. Balance sheet focus. Liquidity primarily concerns current assets and liabilities. Solvency looks at total assets and liabilities, while profitability examines the relationship between income and assets, equity. 3. Risk level. Liquidity issues are generally lower risk compared to solvency problems, which can lead to bankruptcy. 4. Regulatory emphasis. Banks face strict regulations on both liquidity and solvency, while profitability is more of a performance metric for shareholders and management. 5. Interrelationships. While distinct, these factors are interconnected. A highly profitable bank may have better access to short-term funding, improving liquidity, and can build up capital reserves, enhancing solvency. Understanding these differences is crucial for comprehensively assessing a bank's financial health and performance. In conclusion, enhancing your financial acumen is not just about being good with numbers. It's about understanding the bigger picture, making strategic decisions, and accelerating the bank's progress toward the long-term goals while improving short-term profitability. More importantly, it enables you as a manager to communicate to your subordinates, clients, regulators, and other stakeholders what the numbers mean in the context of Standard Bank's goals in e-commerce and its journey to a digitally enhanced future. Thanks for watching, and don't forget to put away your phones, open your minds, and join the sessions over the next 4 Tuesday afternoons.